If you have kids, you don't want to miss this episode. It's called Child Millionaire, how the infinite banking concept can guarantee your child becomes a millionaire. Hi, everyone. I'm Darren Mitchell. Welcome to Control and Compound. Joining me as always, Christina White. Christina, how you doing?
Hey, Darren, I'm doing great. Excited to chat about kids policies. We always have a lot of questions around this, so I'm excited to dig into it.
Yeah, and we're going to talk about this financial strategy using this cash value life insurance on kids. We're going to talk about the benefits. We're going to actually dig into a real life example. So we're going to share actual numbers. Some people have been asking for actual numbers, so we're going to share numbers today. So we're going to dig deep. So I'm looking forward to it.
Yeah, before we jump in, though, I do want to remind everybody, if you're listening on your favorite podcast platform, please make sure you subscribe and leave that 5-star review. And if you're listening or watching on YouTube, please like, subscribe, and hit that bell button so you always know when new content's coming out. Okay,
Christina. So we are both parents, and I don't know any parent whose life didn't change that day your first or second or third child was born. So let's dig into the kids' policies.
Yeah, absolutely. So for anybody out there that has kids, you know that from the day that they were born, you've been wondering what to do to keep them safe, set them up for financial success. Who doesn't want their kid to be more successful than themselves, right? Like that's always the goal. That's what we want to do with our kids. And when we set these policies up, when we set the kids up for the infinite banking concept, that's what we're doing. We're really setting them up for success. So, and not just financially. We also talk about, the financial education aspect. So understanding how these policies work, how they can build out their wealth. But it's also teaching them about stewardship and financial stewardship and how by sacrificing a bit today, they can leave more for future generations and they can leave that legacy. And maybe they give up a little bit today to have something more down the road. So we're teaching them a number of things, right? We're not just setting them up with this strategy. We're also teaching them financial education and we're teaching them that financial stewardship that I think is really important as well.
Yeah, and I think, why start early? Well, I mean, that's sort of self-evident in some ways. One of the beautiful parts of cash value life insurance is you get on this compound interest curve forever. And the longer you can be on a compound interest curve, well, the more exponential growth you're going to have. So if we can start them early, that's an incredible thing. And we're really teaching kids about money, right? Now, maybe not when they're 1 or 2 years old, you're going to be teaching them about money. But I started teaching this concept to my kids, once they hit double digits and a little past, they knew I had policies on them and they knew what they were going to, our plan to use those policies for. So teaching those kids about that. And it goes beyond the policy too, teaching the kids the importance of saving. Canadians don't save enough. This is what we're doing, saving. This is going to be for your benefit someday if, you follow mom and dad's rules and you do what you're supposed to do. So it's a really good way to start young to get on that compound interest curve, but then it's a built-in system you have, like a family banking system, but it's a built-in system to teach your kids about money, to teach your kids about the importance of saving. So I love it.
Yeah, absolutely. And, we both do this for our kids ourselves, right? We've had those conversations, but I've also sat down with clients' kids that are now ready to, and they're like, Christina, can you sit down and just kind of go over the education session with the kids? And they'll all be on there, they'll be on there learning about it. And it's amazing to see younger kids, like in their teens, wanting to learn, like they want to learn this stuff, right? And it's not out there in school. So I think that's huge. Okay, so going back to the infinite banking concept for kids, you talked about that compound interest growth curve and how we want to stay on it for life. Well, the thing about kids is they have a really, really long curve. They have a lot of time on their hands, right? Especially when we set them up younger, huge compound growth. So you can start them with smaller policies that can get just as big as some of our larger policies come retirement and in the later years because they've got that time on their side, right? They've got that compound growth. So we get them on, the goal is to get them on that curve early. So we've got that savings plan set up. They've got money going into it. It's growing uninterrupted. Now we talk about uninterrupted. How do we keep, what interrupts that compound growth curve? What throws the kids off of it long term? Well, it's those wealth destroyers we talk about, right? We've got the taxes, the fees, the volatility, and spending our money. And with this strategy, with using the policy, we eliminate all of those things, right? It's going to grow tax-free. We're going to spend it tax-free. When we die, it's tax-free. We're going to eliminate, well, not eliminate the fees, but like fees in here, typical mutual. If you're investing in an RESP in the stock market, your fees can be upwards of 2%. Fees in here, federally regulated, around 0.13%. So we've got very low fees. Volatility, we do not have the ups and downs of the stock market. It's not correlated, so we don't have those big shifts and swings. We can't lose our money, right? Once a dividend's been paid, it becomes vested. You're not losing money like you can investing in the stock market for your kids. And spending's huge for kids, right? Because what ends up happening with most of our savings for our kids is we save it, they go to university or they go to school, they spend it. We save it, for a down payment on a house, they spend it. And then they're never staying on that curve, right? So by eliminating that through our policy loans, we can keep the kids on that growth curve, right? So that's kind of in a nutshell how it all works. When it comes to tax implications as well, outside of just the growth, but when we give these policies to our kids, so like we said, we both have policies for our kids. Well, we're the owners, right? Like we decide what actually my 15-year-old son does not get to decide what happens with that policy. I am the owner. I decide what we use it for. But down the road, when he learns that financial stewardship, when he learns the financial education, the plan is to pass that on to him so that we can create that legacy. And when I do that, it's tax-free. There's no tax consequences for passing a high cash value life insurance policy down to your kids or your grandkids for that matter. So both of those two things are, really big from an estate planning side of things because it's going to be around for life. It's the insured's your kid. And the minimum age for these is only 14 days old. So you can set these out like really young. And if you think of setting up a policy for a 14-day-year-old child, the numbers get huge. Like they almost sometimes people look at them, they're like, this can't be real. But like it is because they have that much time on that compound growth curve.
Yeah. And like, this isn't a moneymaker for us at Control and Compound. This is, we have a lot of clients that have this and then they have kids and we want to help their kids. But these are fun to do for us because, again, you stay on that compound interest curve. You build in so much flexibility. You build in ways that they're going to be able to use this sometimes 30, 40 times in their life. They could take policy loans and use this. So it's really impactful and it's just giving your kids that head start, right? Picture, those of you with young kids out there saying to them at 25 or 30 when they're ready to take over this policy, I've given you a 20 or 25-year head start on that compound interest curve, right? Most people start saving when they're 30.
Yep.
They're gonna have a 30-year advantage over those people, and they're gonna have a vehicle now that is just growing so wonderfully that they can start saving into it. So, that's the plan with my kids is I designed the policy so they can continue to fund this because you have to save your money somewhere and there's no better place to save, especially if you're already 10, 20, 25 years into the compounding. It just looks better and better. So let's dig into an example. So we're going to use an example of a newborn, for at least 14 days old in the first year, baby girl. And we're going to use just a $200 a month premium. Okay. We can do a lot more than $200 a month. And we're just going to look at this, right? We're going to assume the parents would probably have policies and there's going to be other death benefits coming in and the kids will probably end up having multiple policies. But we want to keep it simple for this exercise and just say, instead of getting that latte every day, you sacrifice that latte for your child and you put in $200 a month. We're going to pay this up to age 90. So you have the option to pay it up to age 90. You don't have to, right? If the kids want to take a few years off, you can. But again, we always do kids policies where we illustrate where the kids can continue to pay. It doesn't make sense to only do a 10 or 20 pay and then never make another payment. We want the kids to continue to pay this policy because we've done that financial education and stewardship where they know the importance of it, the importance of saving. And then we're going to assume that the loans here are repaid, right? So when you take a loan, you repay it. You take a loan, repay it, so you can use it over and over again. But if we start with a child, a newborn girl, at $200 a month, if we fast forward to year 20, so you've paid $48,000 in premiums, your cash value is $65,000 now, and your death benefit is $630,000. So you have $65,000 there. Maybe your child goes to university. Maybe your child doesn't go to university and wants to start a business. Maybe your child decides to go to trade school. Maybe your child gets into AI right out of high school. So again, we're not restrictive like the RESP, where if your kid doesn't go to education, then it's a disaster to try to unwind that and taxes and paying back stuff. It's terrible. We call it infinite banking for a reason. It's literally infinite amount of ways you can use this. Okay, so that's 20. Great. We help with the university. Now let's fast forward to 30. The total premiums paid at this point were $72,000, but now your cash value is almost $150,000. So there's $150,000 in there, and the death benefit is pushing $1,985,000. So now they're 30, and they go, time to buy your first house, time to buy the first income property, hopefully for my kids, that you can live in part and rent part. That's huge. So you're going to basically set them up for their first home or first real estate purchase. And another thing people don't think about, because we never want to think about kids getting sick or an ailment or something, but what if your kids are uninsurable down the road? What if your kids get something that, they're going to live a long time, but they're not going to be insurable? Well, we've got a death benefit of almost $1 million. So let's picture this baby girl is now married at 30, buying the first house, has a kid or two of her own, and can't qualify for insurance, but obviously she'd like to protect her family in the event of her death. Well, now we've kind of guaranteed, or we have guaranteed, they're going to have at least $1 million, close to $1 million of death benefit by the age of 30. So again, all kinds of flexibility in this, and it's going to do so many things at so many different points in their life. So now we're going to keep going along another 10 years, and we're at 40 years old. Time to start a business, right? Dad, I've learned all this. Now I'm going to go start my own business. Or, Dad, you know what? I want to buy those rental properties that, you taught me about, and I think I'm finally in a position to do it. Well, at age 40, we've contributed $96,000 in premiums. Now, this would have been part of our contributions, part of our child's contributions. When they took over this policy, they continued to pay the $200. We've got a cash value of $300,000 now. Yeah, this is getting fun. We're on that exponential growth curve.
Yeah.
And we've got a death benefit of $1.4 million. So if they're a business owner, that death benefit could really come in handy, maybe to secure a loan, to do a couple different things. But now $300,000, we can access 90% of that to do that, buy that business, start the business, invest in income properties, invest in themselves, all the ways that are going to make them wealthier long-term. You're setting your kid up today to be able to do that. We fast forward to age 60. Congratulations, you did it. Your child is now a millionaire. The cash value at age 60 in this policy is a little over $1 million, $200 a month. So you put in $144,000 over that period of time, and your cash value is $1 million. That is pretty cool. And our death benefit's up to $2.7 million. Now, your kid's going to live a long time, so they're not going to retire at 60, or they're not going to need to access this at 60, let's say, for retirement. So we're going to use 70 as, okay, maybe you're retired at 60 and you used other assets, but at 70, I don't want to do any more real estate, Darren. I don't want to buy another business. I don't want to buy more X, Y, or Z. What can the child do with it at age 70? Well, at age 70 now, we've contributed $168,000 between you and your kids. Our cash value is $1.8 million. So we went from 60 to 70, from $1 million to $1.8 million. And our death benefit is $3.5 million. We're getting into some big numbers here, even though this is a $200 a month policy. We're not talking about additional policies, parents' policies, other inheritance, all that stuff, just on this policy. So let's say the child goes, okay, now I'm going to access tax-free loans every year of, say, $100,000. So whatever other retirement income they're going to have, you're basically going to be able, or this policy is going to be able to provide them $100,000 a year of tax-free income. Won't show up on their government benefits, won't show up on the tax return, just $100,000 on top of whatever else they have tax-free. And let's say we do that for 20 years, from age 70 to age 90. They've borrowed $100,000, $2 million. They're not even going to pay the interest on it. Let's say the interest accumulates, you can capitalize the interest. And so that's $2 million. Let's keep my math simple. Let's say it's $3 million with the interest. So at age 90, they would have spent $2 million, and let's say with interest, $3 million outstanding loan, which is pretty cool.
Yeah. Very, very cool. I always tell people if my mom told me that I could put $200 somewhere and I'd have $1 million at age 60, I absolutely would do that. Right. Now, just taking it back a step, Darren, people are going to say, okay, well, you just said that at age 70, there's $1.8 million of cash value in there. But now you're saying that we have an outstanding loan of $3 million. Like, how is that possible if you right? Like, I can imagine people saying that. So why don't you just dig into that a bit more?
Yeah. I mean, again, one of the beautiful concepts of the infinite banking concept and this high cash value life insurance is you never interrupt the compounding. So all those times we took loans for the first home, for college, for the business, for the real estate, the policy itself never stopped compounding. It compounded exactly the same whether you had a loan or not. So we mentioned at age 60 or 70, the cash value is 1.8, but by the time they're 90, the cash value is $5 million, Christina. $5 million. So that's why they can actually borrow more than they had at 70 because they're borrowing $100,000 a year. So as the loans increase, the cash value increases substantially faster than the loans. So we grew from age 70 from 1.8 million to 5 million of cash value. And the death benefit grew at from 3.5 million at age 70 to 6 million. So we're at age 90. We've contributed $216,000 of premium. Our cash value is 5 million. Our death benefit is 6 million. And let's say the child dies at age 90, what's going to happen? The $6 million is going to be paid minus the outstanding loan of 3 million in my example. So now $3 million goes to these future grandkids on this 14-day-old newborn you have. Future grandkids down the road are going to inherit $3 million. So again, we didn't factor in anything else, mom and dad's policies, any of that. Just for the price of a latte a day, we just did some amazing things. We taught your kids about money. We taught them about stewardship. We funded their college. We got their first house, helped them buy their first house. We got them to start a business. We got them to buy income property. We got them to have $100,000 a year of tax-free income. We left our future grandkids $3 million. This is an impactful thing that we can do with this one policy.
Absolutely, Darren. You did a great job breaking down that example and the illustration. So sometimes, it's hard when you see it in front of you, it's hard to look at those illustrations and say like, oh, what's happening at this year and that year, but breaking it down by age and showing you exactly what can be done and putting real examples to it just shows that it happens and people do it every day, right? And we're just talking about a $200 monthly deposit. You can put in whatever number you want, right? Whatever you want to save for your kids and your future grandkids and, create that wealth and legacy, you can do, right? You decide what the deposit amount is. So you can absolutely choose whatever amount you want to save for your kids. And it just shows that you can, it's so impactful, right? Like it's amazing what can be done. And that's what I meant by like the numbers are almost crazy. When you start going through them, it's almost unbelievable that that's the type of impact uninterrupted compounding can make.
I love it. Great recap, Christina. You want to learn more about a child's policy? You want to learn more about a policy on yourself? Please reach out to us at Control and Compound. We're here to help. Thanks for watching. Thanks for listening. Have a wonderful day. Thanks for watching this episode of Control and Compound. Don't forget to subscribe and hit that bell button so you never miss a new episode. And if you're ready to learn more, head to our website, controlandcompound.com. The link's below.